Risking $1,000 to make $5,000 isn't just possible, but it's the exact strategy I've been using to make me over $1.1 million over the last 6 years. But in trading, risk is the only thing that we can control, so if you want to become extremely accomplished as a day trader, you need to learn to master the concept that is risk management. So in this video, I'm going to break down exactly my personal risk management plan, how to create your own plan, how to calculate position sizing, how to properly use risk reward, and how to collect R for data. All of which you can use to trade smarter and have the rules that make it mathematically impossible for you to blow your account. Stay with me to the end of this video and I'll show you exactly how to build a risk management plan that actually makes you money. So the first key step to risk management is understanding what risk is in trading. Risk isn't just about how much money you could lose on a single trade, it's more about how you continuously control downside potential so your account never spirals out of control. Most traders think that risk management is just about setting a stop loss, but it's so much more than that. True risk management is about structuring all of your trades so when you lose, which you inevitably will, you lose a predefined amount that you're comfortable with. It's about having a system that protects your capital and ensures that no single trade can wipe out your entire account. It's also about ensuring that every single trade that you take makes sense in terms of upside potential versus downside potential. Without risk management, one bad day, one emotional decision, one over-leveraged trade can erase weeks or even months of profit and progress. Now, if I didn't implement a proper risk management strategy from the beginning, I would never have been able to make over $1.1 million from day trading. Many beginner traders don't understand why risk management or risk reward is important. In fact, 99% of traders find the topic extremely boring because it's not shiny or sexy like other areas of trading. But unfortunately for many of you, this is what stands between you and the profit that trading brings and ultimately the financial freedom that trading can bring. So to succeed, you need to understand that trading isn't about winning every single trade. It's about controlling risk in a way that allows you to win over a long period of time and not just winning on a single day. That's the only way you're going to survive as a day trader. So without further ado, let's dive into the charts so I can show you exactly how to do all of this. On the screen right here in front of you are the first few things that I'm going to need you to understand before we go into anything else. So the goal of a day trader is to stay alive in the game of trading for as long as possible to increase your chances of success. And this is only made possible with proper risk management and a strategy. Now, unfortunately, beginner traders tend to only focus on what strategies they want to trade, what markets they want to trade, how they're going to make money, and so on. And whilst all of this is great, they rarely focus on risk management and how to protect the capital, which is by far the most important thing. So as you can see from this bottom bit, they don't understand that trading is just as much about capital preservation as it is about capital generation. And capital preservation is only made possible with a well-defined plan that allows you to avoid taking on too much risk, too much exposure, and too much potential for a significant loss. In my personal risk management plan, every trade I take already has a predefined stop loss and predefined take profit target. Before I enter any position, I already know how much I'm willing to lose if I'm wrong and how much I stand to gain if I'm right. This is all done by clearly defining where I'm entering and where I'm exiting and calculating my position size accordingly to all of that. So a big downfall that many traders have is they focus on how much money they will make in a trade, but on a professional level, the first thing that you need to identify is how much money you will lose in a trade if your thesis is wrong. This is what allows you to protect your capital and your downside as a priority. Now, in order to do that, you need to calculate your position sizing based on the position that you're looking to take. So if we go ahead and pull up a long position here, what you need to do is look at how big your stop loss is so you can identify how big in points your stop loss is here. For me here on the Nasdaq futures chart, I'm working in points. Maybe you're trading forex or you're working in pips or something else. But for this example, let's completely forget about the chart or the asset and let's just use the number. So right now you can see I've got a stop of 262. I'm going to go ahead and reduce that to 100. And in this example, let's pretend that each point represents $1. So a 100-point stop loss would equal a $100 loss in this case. Now, if we go ahead and also make the take profit target down to 100, now we can see that this is a 100-point stop loss for a 100-point profit target. As 1 point represents $1 in this example, if this was my trade position, I would stand to lose $100 and make $100 depending on the outcome of the trade, otherwise known as a 1-to-1 risk to reward. For every $1 that I'm willing to risk, I'm potentially making $1 to the upside. So again, for this example, I'm risking a potential of $100 to the downside if my stop loss is hit, and my upside potential is $100. Now, essentially what we're looking to do is trade strategies that give us more than a 1-to-1 risk to reward ratio. So if we found a trade setup on a day that allowed us to set up the position more like this, with the upside potential target of 200 points, this would be known as a 1-to-2 risk to reward ratio trade. This is because our downside potential of our stop loss here is $100 and our upside potential is $200. This means that for every $1 that we are risking in the market on this trade, we stand to gain a potential upside of $2. Now, obviously, we want to risk the least amount for the most upside potential, but it all has to make sense in terms of strategy and trading models. Now, it's really important that you learn and do this first, because this means that you're able to see if the trade setup makes sense from a risk perspective first. Think about it. Would you risk a potential downside of $100 if you only stood to make $5? Probably not. But if you could risk that same $100 to make $500, you would be way more willing to take on that risk. And what that looks like on the chart, if you risked $100 to the downside for a potential $5 gain, you definitely would not be taking on that risk. But if you could risk the same $100 to the downside and we go ahead and risk, you would be way more inclined to take on that risk. Now, you already heard me use the term risk to reward, but for the beginners here, essentially what that means is for every dollar you risk, how much do you stand to gain back? What you're risking has to make sense to what the potential reward is. After all, there's a 50% chance that you'll be right or that you'll be wrong, so it's got to make sense if you want to make money long term in the market. Demonstrated earlier with the $100 loss for the $5 gain. If a trade setup presents itself but it doesn't make sense from a risk component, I'll never take it. So for me to take a trade, the minimum risk to reward ratio has to be at least 1-to-2 R, meaning that for every $100 I risk, my potential reward is $200. What that would look like on the chart would be down this way. In this example, where each point represents $1, my stop loss is $100, my take profit is $200, and this is calculated as a 1-to-2 risk to reward ratio for this trade. For me, doing this is non-negotiable. Because I understand my risk to reward profile, I can filter out bad trades before even taking them. If the risk makes sense, I'll take it. If the risk doesn't make sense, I'll pass. No emotions involved. I simply stick to the plan, and this alone saves me from losing thousands of dollars. Now, in order to create your own plan, you need to consider your account size and identify your own risk parameters and define what 1R is to you. So your 1R is going to look very different from what my 1R looks like right now. As a general rule of thumb, you can follow a 1% rule, meaning that you can risk 1% of the account per trade. This means that if your account size is $10,000, then each trade you would take, you would risk $100, and this would be defined as your 1R. So if your 1R is defined as $100, you should never be risking more than $100 to the downside per trade. So what that would look like here, if your 100-point stop loss meant that you were losing $100, that would mean this loss is a 1R loss. If your 1R is $100 and you stood to make $200 and you hit your take profit, this means that you would have made 2R, making this a 1-to-2R trade. This is something that you need to drill into your mind. You need to define what 1R looks to you depending on your account size, and you need to stick to that as your max downside per trade. If you are consistently losing more than 1R per trade, then you're not calculated, you're simply just messing with your capital and gambling. Consistently sticking to a predefined loss limit, in this case 1R, is what's going to keep your risk management consistent. So let's use an example you guys can actually put into practice. I know a lot of you guys love prop firms, and so let's use a fresh 50k trading account. So if you're on a 50k challenge account, I guess you could use the 1% rule, and this would mean your 1R would be defined as $500, because your 1% risk to the downside would be 1% of the 50k account, which would be $500. However, I would suggest you define 1R as $300. This means that a 1-to-2R trade would be risking a potential downside of $300 and a potential upside of $600. And a 1-to-3R trade would be risking a potential downside of $300 to a potential upside of $900. Now, you might be wondering why $300 if 1% of a 50k account is $500. Because on prop firm, the account challenges, the max drawdown a lot of the times is around $2,000 on a 50k account, and if you risk $500, you can only lose 4 trades in a row maximum before you've blown the account and hit the max drawdown limit. If you risk $300 per trade, you can lose 6 trades in a row and still be in the game, and therefore you have more longevity. It's about managing that risk and not rushing the process. So what this would look like again on our position, if we had 1R as $300, you wouldn't necessarily come and have a 300-point stop loss if 1 point represented $1. What we do in this scenario is increase the amount of contract shares, whatever it is that you're buying, and don't make the stop loss too big, but in fact just increase the position size and margin. Now, in order to do this, we need to calculate our position sizing and only enter a trade with a specific number of contracts. I'm going to use contract in this example because, again, my chart is the Nasdaq futures. So what does this look like for you? So how I calculate this is just like this. So what we can see is one MNQ, which stands for micro NQ contract. 150 points would give me a $300 stop loss. So this is how we would calculate it. For the sake of this example, like I said, I'm on that Nasdaq futures chart, so I'm going to be using contracts. So one micro NQ contract at 150 point stop loss would give me a $300 loss. If $300 is my definition of 1R, which in this example for you guys on a 50k account it could be, then this is exactly how we're going to risk $300. And in the case that our trade position has a 75-point stop loss, we would go ahead and place 2 micro NQ contracts as our position sizing and margin for this position. The same applies if we have a 50-point stop loss, we would go ahead and use 3 micro NQ contracts and so on. So what we need to do is if we enter here and the stop loss is here, no matter how many points it is, you need to look at how many points away is your stop loss and then use the correct amount of contracts that will make that stop loss trigger a 1R loss. And in this case, 1R is $300, and this is what we call position sizing. So the next thing that dictates your outcome is your trading models. So your trading models should give you at least a 1 to 2 risk reward ratio on average. Your loss in this example should be no more than $300 consistently, and your wins in the scenario of a 1 to 2R trade should be $600. So I hope that helps you understand the concept of risk reward and using R. Now, this is why I consistently trade 2 models only, the ILM and the orb. They're both repeatable, they're both very mechanical, and they produce great risk reward ratios per trade. Now, if you stay to the very end of this video, I'll teach you exactly how to trade these models. But for now, let's go and have a look at a real-time example using these same calculations. So I'm going to show you the trade I took yesterday on April the 4th, which was an orb position, and it collected 2R for me. Obviously, like I said, in this example, we're using the definition of 1R being $300. My 1R and your 1R, or the R of this $300, is going to be extremely different. So if we come back to the chart, we hit the 15-minute time frame and we look for New York Stock Exchange open on the replay tool. So we're going to look for 2:30 UK time. Here. Now, if you've watched the orb trading strategy video that I did a little while ago, you know the first thing we do is mark out the orb high and the orb low, which stands for opening range when market opens, the first 15-minute candle. Then essentially what we do is wait for a 5-minute candle closure break to the upside or to the downside of the orb range. So let's go ahead. Here, you can see this is where I would have taken entry. You can see here we've broken to the downside. And if you've watched the strategy video, you know that we need to use the fib retracements for our standard deviations. And we would always have our stop loss at the 0.5 middle of the range. So what this would look like is we entered here, stop loss at the middle of the range, and we're usually targeting an area of liquidity on the left, but I went ahead and targeted 1.5 standard deviations. And as you can see from this, I have a 158-point stop loss. If I go ahead and bring my contract sizing down, so with 150 points, if my 1R is defined as 300, I calculated that I was only able to use 1 contract to make my max downside loss of 1R, in this case 300. So in other positions, I might have needed 2 contracts. In other positions, I might even use 3 contracts. But because my stop loss range is quite big in this position and at the 150 mark, I went ahead and only used 1 contract. Then I set my take profit at the 1.5 standard deviation, and you can see this gives us a 2.11. I'm just going to round down. This gives me a 2R trade. So in this case, we're using this contract sizing. If I define 1R as $300, then in this trade, I would have been risking $300 if my stop loss was hit and $600 if my take profit zone was hit. And this is how we consistently control risk. We need to execute every single trade like this, calculating the risk to the downside before entering the position. And that's by looking at how big the stop loss is, looking at the position sizing, and only entering when it makes sense from a downside risk perspective. This is the most crucial and key thing. You need to ignore how much money you think you're going to make, because the one thing that we can control is how much risk that you're taking on. And then we go ahead and see how this trade plays out. And there we can see the full take profit is here, giving us that 2R collected. We go ahead and put it in our journal, and that's how we first manage risk to the downside when we're taking a trade position. Now, in the very beginning, I was very consistent with my risk and I kept my R the same for each trade. For example, 1R equals $300. Once you start gaining a little bit more experience, once you prove to yourself you can be consistently profitable, you can start adjusting your risk and be dynamic with it. For example, if I have an A+ setup like this trade and I have high conviction, I'll increase my risk for bigger returns because I have the capital to do so now. Because I have the capital to do so now, which I didn't before, if the market conditions are choppy, I'll reduce my risk and I'll be more conservative, and I'll say it's a half risk day. But if you're new, I would suggest just keeping your risk consistent, kind of getting familiar with managing your risk and defining your R and pre-calculating your dollar value that you're happy losing per trade, and just do this consistently until you become profitable. Now that you've learned how to calculate your risk and how to measure your success or your trading in R collected, risk collected, the next thing I'm going to want you to do is begin journaling. So I want you to journal, not necessarily with the P&L, but with R collected, because you can start to identify behavior patterns, like if you're over risking. So you can see, I try to never let my risk go above 1R per trade. This means that I know exactly how much I'm going to lose if my trade thesis is wrong and the trade goes against my bias. I'm very comfortable and I'm already accepted that loss before I enter the position. Therefore, my losses cannot spiral and I can consistently be profitable as long as my win rate is good and my risk to reward is good. So again, scrolling through my journal, you can see 0.8, 1, 1, 1, half position risk, half position risk, half position risk, 1R loss. I never ever lose more than I'm comfortable with losing, and this is what you need to do to become a successful trader over time. Now, with that said, you're going to need some trading strategies that obviously are going to help you win, because another misconception in trading is that you need to have a really good win rate, but that isn't necessarily true. So coming over to look at this reward and win rate cheat sheet, again, a lot of people think that you need a 70-80% win rate, and if you do, that's great. But for the majority of people, if you can consistently trade a 1-to-2 risk to reward ratio, you could be profitable with just a 40% win rate. If you can consistently trade and win with a 1-to-3 risk reward ratio, you only need 30% win rate to become profitable. So you can see that the notion of needing an incredibly high win rate is actually false. If you understand risk management, and how to collect and track your performance in R rather than in dollars. And again, I just want to drill the message home. I never measure my performance metrics, KPIs are never in dollars. It's always in R. It's always in risk. Focus on risk first, as this keeps you controlled. Focus on risk because it keeps you stable and it gives you consistency in the market. Now, I want you to remember, it's not about how much money you make, it's about how much you risk to make it. And I want you to remember that over time. This month, how much did I risk? This year, how much did I risk? Doesn't matter how much money you made. If you're profitable, then amazing. But the main point you need to focus on is how much you risk to make that money. Because if you're risking way too much, you're not going to have longevity of a trader. You might have had a great week if you're over risking and over leveraging everything, but it's only going to take 1 or 2 or 3 bad trades when you're over risking, over leveraging. You'll wipe out your weeks, months, and even years of profit. So you really need to drill this R, risk management and risk collected, into your head and measure and base your performance based on that. So I have a monthly R collected goal, and if I measure my success in R rather than dollars, it makes me far less emotional. So in Playbit, we advise our traders to aim for a 10R monthly goal. This means that if your downside risk per trade of 1R is $300, you're aiming to make a minimum of $3,000 per month, as that would be a 10R if 1R is $300. Now this is realistic and it allows them to stay on track month on month, and I suggest you do the same. Having a monthly goal also cancels the noise of having a daily goal. So if you lose on one day, it doesn't matter, as you can make it up any other day of the month, which is great for psychology, especially for those who get really het up about losing on one day. Saying that, with what you learned in this video, you should never be annoyed or get emotional about the loss on a day, which you inevitably will lose, because you will be comfortable and have already accepted that loss if you're calculating your position size and entering based on everything that you've learned in this video so far. So now obviously, if you're defining 1R as $300, you're going to need to know how to scale that over time. So for me, because my personal capital and my personal situation and my personal experience is different from yours, my 1R is going to look different as well. R is something that you scale up over time once you've proven to yourself that you can be consistently profitable in the market, and when that time comes, you're ready to take the next step. For example, a couple years ago, 1R for me would have been $1,000, and if I hit a 1 to 5R trade, I would have risked $1,000 to make $5,000, which happen fairly regularly with the right strategy. Now, as you improve as a trader and look to scale, it's only the capital and the position sizing and the definition of 1R that should increase. The model, the strategy, the plan, the risk control, and everything else needs to remain the same. All you need to do is learn to turn $100 into $1,000, $1,000 into $10,000, $10,000 into $100,000, and you would have acquired the skill to multiply any amount of money in a controlled manner through day trading. So what that actually looks like in terms of figures, I'm going to use the NQ contracts again. So once you're ready to level up and you're no longer looking to risk 1R as $300, you would just change the amount of points per contract and then you would adjust based on that. So you would very unlikely have a 250 point stop loss because that's just absolutely huge. If you're ready to have 1R as a $500 loss, you go ahead and line up your position. And if you had 85 point stop loss like so, you would go ahead and have your position sizing as 3 contracts. Same thing applies if you're ready to go up to $1,000. We're not going to have micro contracts anymore. We're going to go to mini contracts. We're not going to get into the definition of that, but for the sake of this video. So if your 1R became $1,000, you would have a 100 point stop loss, which would look like this. So everything is dynamics, everything is in flux. Obviously, it changes with your trading model, it changes with your personal strategy, it changes with your personal capital situation, with your risk plan, and with your experience as you scale over time. So this is the foundation and you need to learn this and obviously just scale from there. So if your risk is managed properly and you apply all of this, you shouldn't ever have more than a 1R loss, as I mentioned earlier. That's your predefined downside and you need to stick to that every single trade. Now, if you enter a trade and set your stop loss to risk your 1R, let's go back to the $300 example, but you move your stop loss in that trade and you actually end up losing 3R, which would be $900, then that's your fault. This is a huge red flag if this happens frequently and you will not have longevity as a trader. This is probably the reason that you're not consistently profitable if you are moving your stop loss and losing more than your predefined comfort amount. You need to stop this behavior immediately and apply everything that you've learned in this video to really change your trading. Learn to use R like this, learn to manage risk like this, collect data for your journal in R, and I promise you, you're going to become a very, very good trader when you become disciplined in this area. Now, I just want to emphasize the message again. I don't care about your P&L. You should not care about your P&L. I don't care about my P&L in terms of profit. I only care about what I or what you risk to make that amount of dollar. And that's why we calculate it in R. So focus on the process and the skill of becoming a better trader, and the money just shows up naturally. Focus on the money and you're going to end up losing more of it. Look at every trade from a downside perspective first and accept the loss before you even enter the position. And then look at the upside and see if you can make at least 2 times what you're risking with the trading model that you're using and with the trade that's playing out. That way you can see if the trade makes sense from a risk perspective first, and that's what you need to do to have longevity, sustainability, and control within the markets. Now that you understand the steps to mastering risk, position sizing, risk to reward, and using R, let me teach you my most profitable 2 trading models so you can stop blowing accounts and finally turn profitable. So after this video, I want you to click this video here to learn the 2 trading strategies I trade during the New York Stock Exchange Open that makes me thousands every single day. If you made it this far, you now understand how to structure your risk like a pro. The difference between winning traders and losing traders is how they manage their risk. So I urge you to put emphasis on your risk planning more than anything else in your trading. Now, if you do this, I promise you, you're going to see better results. If you need additional support, please check out the description below where you'll find my free trading journal template, trading community, and much more to help you on your journey. As always, I'm rooting for you and I'll see you in the next video.